Hello, everybody, and thank you for tuning in to the Liberty Report. With me today is co-host Daniel McAdams. And Daniel, good to see you.
Good to see you, Dr. Paul.
Good. There were a couple important meetings this past week having to do with money and a little bit of politicking. The Federal Reserve had a secret meeting. They announced it because they're supposed to, but the secret meeting, what they talked about, that is secret. We won't get to know about that, because we're not privileged people. Even the people on the banking committee won't know about it. But what was interesting is immediately after the first secret meeting with the Fed occurred, Yellen rushed over to the White House to have another secret meeting with the president. Of course, the Fed is not political, but she just had a little chat about family things. And then shortly thereafter, there was another major Fed meeting. So I imagine you saw that. What crossed your mind when you saw all this happening?
Well, the first thing I thought is I want to ask Dr. Paul what he thinks went on in these meetings.
Well, the first thing that came to my mind was, what's the motivation behind this? Yeah, what goes on? They're admitting the truth. They know what we know, and they're dealing with the problem. But to me, it's this pretense that everything is okay. All the statistics are okay. They can't find anything wrong. But we better not raise interest rates yet because the European markets are still weak. But I think for them to do this much, they are a lot more concerned than they're letting us to believe. And so I think this is a very significant meeting that they had. But eventually they'll not be able to come up with anything other than propping up the markets. And maybe the meeting did have some significance because the last several days the market has popped up again, and evidently Wall Street was reassured. But the question we raised is, what are they going to do about Main Street? But Yellen, in her public announcement, she's all for Main Street. We have to concentrate on Main Street and jobs and taking care of people. And I was kidding a little bit with you. I said, well, maybe the Fed has become populist too. Everybody has to talk about Main Street now and shy away from Wall Street. So there's a little bit of that going on. But quite frankly, they're not going to change their policy. I do not see how it's going to be any boost to Main Street because our problems are structural and they're not going to be temporarily helped by manipulating interest rates as it does for Wall Street.
And our interest was really piqued by a piece on Zero Hedge this morning that outlined this sort of shift in Yellen's rhetoric toward, I guess you'd say, a more populist streak. But she said, we are focused on plentiful jobs and stable prices.
Wow.
We're for the common man, trying to dispel this idea that these are the banksters in secret meetings.
I wonder if she ever considered free markets and sound money. That might be a good jobs program. I would like to get a chart up here because Hedge had a chart of the various things to sort of disprove this rosy scenario. Everything is going well for the country and they don't have to worry about things. But if we could take a look at that chart and show that these various things have been going down and not improving. So I don't know. Here we go. If we take a look at this is significant. He has nine things there and the direction of what's happening, and they ought to be concerned. They ought to be concerned about Main Street. They ought to be concerned about world economies and the dollar and everything else. But here we take a look at student loans skyrocketing, and right now Obama's setting the stage for allowing a declaration that they don't have to pay them off. I think 40% are not paying their loans off, and that's a big deal. I mean, that's another $1 trillion or so that's out there. And once they exempt 30 or 40 or 50%, why would the rest of them pay anything? Yeah. They're going to quit paying. But it's a wonderful employment economy right now. They're always claiming that unemployment. I think we wanted to keep that chart up for a little bit longer. The employment is actually down, they claim, but take a look at the people on food stamps. That is up. Has it done any good for the federal debt? It's still skyrocketing as usual. But, well, everything's being held together for Wall Street with the money printing. Look at the chart on money printing, straight up. And Obamacare hasn't solved the problem of quality care. The middle class hasn't done too well with that, and the poor haven't done too well, but the costs are skyrocketing. But here's the important figure on the labor participation force. So if you don't count a lot of people, you sort of fudge these figures and hide some of the real problems. Inequality in the economy, minorities are not gaining any, and we do know that minorities do quite well prior to the time we had minimum wage laws. And then median income, that's down. So where's all this money going? They're printing this money, they're spending the money, and interest rates are low. No economic growth, median income is down, and one consequence has been that even with essentially hardly any interest rate to pay on a mortgage, housing ownership is straight down. So I don't know where anybody can get satisfaction with what is going on by looking at the stock market. It looks like Wall Street's doing pretty well.
Well, I'm no financial expert. As a matter of fact, I'm less than a novice. But it doesn't take a genius to look at those two of those charts, juxtapose the money printing with median family income, and how can you look at those together and say that they're for Main Street and not Wall Street? As you said, where's the money going? There's tons more of it, but less of it's getting into the house of the Main Street people.
Yeah, and usually they talk about the stock market and S&P, and one of the charts will have the S&P on there, but a lot of money goes into bonds, and when there's no interest, that means the price of the bond is very, very high. You're paying a lot to invest your money for no interest. So they're very, very expensive. So a lot of money went into bonds, propping up debt and propping up corporate debt, community debt, government debt, international debt. So they say, well, the Krugmans of the world, there's no bubble. There's no bubble. Monetary policy doesn't create the bubble. Well, of course, we had a few. We had a NASDAQ bubble and a housing bubble, and now we have a bond bubble, and the whole system is a bubble in many ways because people make mistakes when they don't know what the real interest rates are. So this getting the truth out is the big problem. But so far, the management by the Fed seems to accommodate, at least give enough reassurance on the very short run. I think the short run is getting shorter and shorter because it used to be that have shifts in policy and it would last for 4, 5, 6 years, then there'd be a correction. But right now I think it's very short. Things go down sharply and things pop up again. But I think the middle class, I think Main Street, they're not messing around with this. They've been stung so many times. So all that money doesn't benefit Main Street, especially since people don't feel comfortable about starting new businesses because of the system and the tax system and all these other problems we have. So the money has to go somewhere, and it goes into those individuals who are allowed to speculate on Wall Street, and there are still many making billions of dollars, and hedge funds. All these things seem to do well in a period where endless printing of money serves a special section of the economy.
Well, thanks to Zero Hedge, we have a second chart, and I think that second chart demonstrates even more poignantly the real divide between Wall Street and Main Street. And maybe
let's see if we can take a look at that because now this is very, very clear. You see the line that's moving upward. That is Wall Street, and I think that's measured by S&P. And then if you look at the blue line that comes over and the arrow pointing down, that's the labor participation rate. And that's down in the low 60s right now, but there's a tremendous change on that. So when the people leave the labor force, then they're not calculated as being unemployed. So it's not a healthy economy. That should be, if you had a healthy growing economy, that line would be what was occurring between 78 up until 99. The interesting thing about this chart, Daniel, is the fact that I work on the theory that our major economic changes occurred at the turn of the century when the NASDAQ bubble burst. And this one sort of points it out. Something dramatic happened in 99. And I think that's when the old-fashioned rules that the Keynesians were getting away with, we can manage this economy, we raise interest rates when the economy looks like it's overheating, and we lower them when they need a little bit of stimulus, and it seems to work. But I think that's all over with, and I think now they have no control. And that probably represents one of the reasons why they're sort of panicking behind the scenes. It would be fascinating if maybe the NSA will give us the recording of what they're talking about in there. But I'll bet they were very concerned about what's going on around the world and in the monetary system, and what are they going to do, when things where we lose control. And I think that's what they're anticipating.
And one of the things you mentioned before the show, and correct me if I'm wrong, but you point out 99 as the date when really the rules completely changed. But I also, if I'm not mistaken, you pointed out 1987 as sort of the beginning of that change, as a significant date where they started realizing they needed to start changing the rules.
Yeah, the big financial event in my transition from only delivering babies to getting involved in speaking out on economic issues, of course, was 1971 with the severing of the dollar from gold, believing that was going to lead us into an age of chaos. And it hasn't gone as fast as some of us believe, but it's there. The chaos is there. But the second one is 1987. I remember it very clearly because they talk about the one day, I think it was the 19th of October in 87, it went down 22%. That was the most in one day ever. Still is the history of it, and it went down over 500 points, and the stock market was only like in the 2,500 range, so it was a big percentage. But if you go back and look at the whole week or two in there, it went down 1,000 points. So it was a big deal. So they even had temporary closure of the markers. They were just really frightened by this. But the sad part of this is that the individual who came to the rescue, in the sense of how do we calm this down a bit, was our president, President Reagan. You say, well, why would you complain about that? He's calmed it down, and we have this President's Working Group on Financial Markets. They get together when there are problems, and they patch it up, and they keep things going. Well, they just make the bubble bigger. And the nickname for the President's Working Group on Financial Markets is the Plunge Protection Team. Mm-hmm. Who's it designed for? To protect the owner of their property and household owners who are going to lose their jobs and lose their houses. It's strictly to protect Wall Street and prop up Wall Street. And they've been pretty successful on this. But since it's topped out, back then it was in a couple thousand, it's gone up all the way to 18,000. But it's wavering up there, and they pumped a lot of money in here, and so this year is very maybe a telltale year on whether they'll be able to regenerate more falsehoods where people will be reassured. But that was a very big event. But one of the reasons why I was discouraged by it was President Reagan was a free market guy. He probably didn't get so much in these decisions. He probably said, well, things are falling apart, you got to do something. So he signs the executive order. And they have a group of four key individuals. They are powerful when it comes to manipulating short-term economic conditions. The president of the Fed, the SEC chairman, the Commodity Futures Trading Commission is up there, as well as Treasury. The kingpin there is the Fed chairman. That's why the whole committee probably didn't go over to see Obama. Of course, that whole committee didn't attend the Fed meeting. Who knows, maybe they did, since it was totally secret. But believe me, that group has a lot of authority, even under the so-called law and their interpretation, that they get involved in markets. If their purpose is to stop the market from plunging and getting out of control, what do they have to do? They have to buy something. So the markets are out there anticipating, what's the government going to do? They're not anticipating economic factors and what about investments and these things. They anticipate, what's the Fed going to say? Even if they agree with the disastrous policy and things are going to end badly, on the short run, today, tomorrow, and the next day, if the Fed says something, if they say that, the market's going to go up. So they go in and they speculate and buy it, and maybe next week they'll want to sell off. Well, eventually, they'll lose total control. They don't have much control right now. So you have this financial working group, and I'm sure they're into the commodities business, the futures business, and they can buy and sell. Actually, they were authorized in the 1930s, where our Treasury could get involved in manipulating gold prices back then. That's where they used to play games, and we were even on a gold standard then that was suspended, of course, by FDR. But they are very, very powerful people, but eventually they're going to be very, very weak people, and they'll be totally discredited. I think central banking is in the transition of being discredited. around the world, and of course that's why we're seeing financial and political chaos in Europe, and you see the bankruptcies, and we're very much involved. I think the only thing that holds it together for us and them being Europe, and who's going to bail out, and the banks are in hock with sovereign debt and Greek things, but they seem to smooth that over, but we're very much involved. As long as the world puts a trust in our dollar, and they will participate in maintaining that trust, because everybody realizes if the dollar goes bust quickly, they're going to lose a whole lot. So it's in their interest to make sure the dollar doesn't do that. So the traders say, yeah, they're going to do it. They'll keep it together. Maybe I'll have time to get out when the time comes. But this has never been done before. The history shows that zero interest rates or negative rates has never happened in 5,000 years. It's so absurd. It's so removed. You know, even biblically, they recognize paying interest, and fair, honest weights and measures. And if you loan money, that interest is a legitimate thing, this sort of thing. But this is coming. This is so bizarre, and it's so worldwide, and it's a paper currency that is all around. So I think what we're doing is smelling a little bit of their concern, and I wouldn't be surprised if we hear of more meetings like this.
You know, we always like to look for the bright side, and so I found an area that I think you'll agree with Janet Yellen, and this was in the Zero Hedge article. I think it was quoting a Time magazine profile, but it said that Yellen admits that there are many things about the economy she just doesn't know, just doesn't understand. And she said the traditional relationship between job creation and inflation seems to have come apart.
Yeah, that was the old saying of the Phillips curve. If you inflated, you got more jobs, but if you stopped inflating, you'd ruin it. But and then finally, in the 70s, they found this term stagflation. Oh, you mean you can have a weak economy and prices still go up? Absolutely. Look at at the end stages, that's what happens. That's the Zimbabwe model. Prices are going up, but the economy keeps going down. And I think we're having a fair amount of that right now.
But the whole notion when she says, there are just a lot of things I just don't know, your reaction would be, well, then don't try to fix them. Or hers would be, we got to keep trying things. She said, the problem is that the global economy is playing by new rules. So it's always someone else's fault. It's never the fact that they're doing it in the first place. It's like the neocons.
Maybe they're playing the old rules of the economy, and she's bewildered by that. Of course, she can't know. I mean, this whole idea, but she's been conditioned and trained over many, many decades. They can know, and they know what a proper rate is of interest, and it's totally absurd. And I just hope that the people understand where the problem, where the problem was when this thing comes down. But I think there's a lot more information like that. See, I sort of, in spite of the way we're doing right now, politically and all, I think we're making some progress with Austrian economic teaching, because there's a lot of people who know there's something very suspicious about the Federal Reserve. Of course, that's something I've talked about for a long time, the Federal Reserve. If anybody wants a sound economy, they have to deal with monetary policy, and they have to reject some of these falsehoods that if you create money, you're creating wealth. That is just not true. It's just so false. And that debt doesn't matter. Debt does matter. So and there's a limit to it, and it always gets liquidated. And that is what the big fight is right now, is how is the debt going to be liquidated? The Fed is praying every night that if we can just liquidate debt at a 2% rate, we'll all be okay. But they have no control over that. And I think, as Daniel points out, Yellen probably doesn't quite realize that. She doesn't have control. They don't. They always told me when I'd quiz them, they said, well, it's okay. We understand what you're talking about. But as long as it's orderly, as long as it's systematic and slow and steady, we don't want these panics. And of course, that's what the plunge protection team is there for, is to prevent the panic. But if you prevent the panic and prevent the correction, all you're doing is building bigger distortion that will cause the ultimate panic and the ultimate escape from the dollar. Then it's going to be much more catastrophic. That is what we're facing. I think these recent meetings are indicating that they are very, very concerned. I think they're up against the wall, and they really probably don't know exactly what to do. So they'll be calling us soon, I'm sure, and asking our advice, and we'll tell them, why don't you just disband not only the working group on financial markets, Why don't you people at the Fed just disband yourself, just leave, let the market handle this. Right now there's a lot of private entities loaning money outside of the banking system because it wouldn't be that bad. We could adapt pretty easily. But it might be that the system they adapt, they might want to, in order to restore confidence, they might say that if we're going to extend credit, we want to be guaranteed that it's backed up by something like a commodity and not by the promises of the politicians that they won't spend money and run up debt and expect the Fed to monetize this. So we're living in exciting times. There's a major transition going on. It's very dangerous, but it's also very exciting and interesting, and we also have a chance that our ideas will prevail. So anything we can do to help push it in that direction, we're going to do it. Our goal is to provide a philosophy that will usher in an age of peace and prosperity. I want to thank everybody for tuning in today to the Liberty Report. Please come back soon.